What's up, guys? Welcome back to the channel. I'm Ty, and this is Stock Muscle. And a company that I like a lot is falling in share price, and I really don't know why. They're in a very hot sector. They own one of the biggest franchises of all times. It's sold millions of copies, but recently the share price has just been going down, and I'm curious as to why. So let's dig in, take a look, and see what we can figure out. This is Stock Muscle. Stay tuned, guys. All right, guys, so Take-Two Interactive. The ticker symbol for the company is going to be TTWO, Take-Two Interactive. One of the best gaming companies in the stock market is actually one of the big three. So when you think of the big three public publishing companies, you're probably going to think of Electronic Arts, which owns the Madden franchise. You're going to think of Activision, which owns the Call of Duty franchise. And you're going to think of Take-Two, who owns the Grand Theft Auto franchise. Now, I think Take-Two is a wonderful company. I started playing Take-Two games way back in the early 2000s when it may have been the 90s, when the Sega Saturn came out, and Take-Two and Visual Concepts first bought the NBA 2K series and the NFL 2K series about. But the company's cash cow has always been the Grand Theft Auto franchise. The latest version of Grand Theft Auto has been out for a very long time, but it's still a major driver in the company's revenue. There's rumors that a sixth iteration is coming, but you know what? They're just rumors at this point. The company hasn't come out and said anything about it yet. So the company recently beat on earnings, really nice earnings beat, but the share price is reversing. So it peaked at about $190 per share, and as of today, it's trading at $170 per share. Now, in my book, it looks like a buying opportunity. I think it looks cheap, but it's not enough to think that a company looks cheap. You have to dig in and do the work. A lot of other YouTube channels out there, they'll tell you to just buy the stock and they won't give you a solid reason to buy the stock. That's not what we do here. We're going to look into the fundamentals. We're at least going to take a look at the old school traditional valuation metrics to get a decent idea of if we're paying too much for the company or if we're paying too little for the company, if we're going to buy it or if we're going to hold it. So we really dig in on this channel. So let's do that with Take-Two. Like I said, I love the company a lot because they own the Grand Theft Auto franchise, and it's been an absolute cash cow for the company. So let's get into it. Let's do what we do here. First thing we want to look at is the company's revenue. Is revenue growing? So it looks like for Take-Two, that's a resounding yes. So let's go back to 2017. It's the first highlighted column. We started at $1.7 billion in revenue. That's grown to $3.3 billion in revenue. So over a 5-year period, revenue has pretty much doubled. That's a very positive sign. Now, Grand Theft Auto 5, the last iteration, came out in, I want to say 2013 it was introduced. So if you look at revenue from 2013 to 2014, you're going to see an explosion. I think that's a solid reason to hold the stock. There's going to be a sixth iteration coming. We don't know when, but if this price gets low enough, I'm probably going to want to buy it and hold it, because if we look at, once again, 2013 to 2014, the revenue, that explosion, once a new title is announced and the sales begin, I think the shares are going to go up quite handsomely. Second column highlighted in yellow is the net income. It's not about what you make, it's about what you keep, right? So the company's also grown their net income very handsomely from just $67 million to over $500 million in net income growth. So the company's really good at the top line and the bottom line. Now, when it comes to net revenue and profit, the reason I love these software publishers is because we're getting away from physical discs. That's going to be a net positive for these publishers because they can almost sell the games directly to the consumer. There is an intermediary. There's an intermediate party, which is companies like Sony, who has the PlayStation Store. So you're going to buy it from the PlayStation Store, and I'm pretty sure they get a cut somewhere there. But they're cutting out the middleman slowly. There's going to be less packaged video games going forward, and that's going to be a huge thing for the bottom line for these companies. If they don't have to physically package as many games, that means it's going to be more money for the company. So I really like what's going to happen with the video game publishers and the migration from physical discs to downloadable content. I think that's going to be a huge deal for the publishers. I think, quite frankly, all the video game publishers going forward are probably going to be worth more money for that reason. They're going to be more profitable companies. Let's go down to earnings per share. Earnings per share has also grown handsomely from just 73 cents per share over 5-year period to over $5 per share. That's what we want to see. Revenue growth, net income growth, earnings per share growth. Remember, guys, what ultimately moves a company is earnings. As a company becomes more profitable, as they bring in more revenue, that revenue trickles down to net income and earnings per share. That's what really drives the price of a stock. Now, I know we're lost in meme land now, and we have this thing where everybody just kind of piles in and buys a stock, and that's driving the price of some stocks up. But, when that's over, remember that what ultimately drives the price of a stock is the company's earnings. So, secondly, let's take a look at the company's balance sheet. So like I told you guys before, the balance sheet is a test of solvency. If a company got in trouble, do they have enough money to pay their bills? So we're going to look at assets versus liabilities. And you probably do this in your real life. If you own a home, you own a car, you've built up some significant monies in your liabilities columns. These are things that are going to have to be paid off at some point. And ask yourself, if I get into an emergency, I lose my job, or this happens, or that happens, God forbid, do I have enough money to pay everything off and make myself okay? I'm debt-free at that point. That's what you want to see in a company. Actually, Ben Graham or Warren Buffett, it was one of the two guys. Ben Graham or Warren Buffett said that assets should triple liabilities, and that looks to be the case here with Take-Two. So they have over $6 billion in assets and just over $2 billion in liabilities. So this company can pay their bills. Third thing we want to look at is cash. Once again, guys, I'm a big fan of cash. We talked about this before. Companies with favorable cash positions can do what? They can launch new products. They can buy back shares. They can issue a dividend. Basically, they can do things that enhance my value as a shareholder. You make your company better, you make more money. That's better for me as a shareholder because, once again, earnings. Your earnings is what's going to drive the share price higher. So the company currently has 124, as of last quarter, 124 million in cash. They've grown that from, actually the cash has kind of been decreasing over the last few years. So they've gone from 245 million to 124 million, but I'm not worried about that. Very capital intensive business. The cost of making games isn't cheap. And the company consistently has to do that. The company's also acquired a few, I believe it's 2 companies in the last 3 years that they've bought into their brand portfolio. So the company's been spending some cash. I'm okay with the cash being down a little bit because I know that this business generates good cash. So company's fundamentally sound. We don't have to worry about that. We've done our checks. Now, I want to know if the company is cheap. Am I buying the company cheaply? How do we know if we're buying a company cheaply? If you don't know anything else, what you want to know about is a metric called the PE ratio. That's the price to earnings ratio. The price to earnings ratio saying is I'm paying $1 for what am I paying for the earnings? And the saying goes, I'm paying blank for every $1 of earnings for the company. So let's look at the price to earnings here for Take-Two Interactive. I highlighted it in yellow. The current PE ratio is 33.7. So I'm paying $33.7 for every $1 of earnings of Take-Two of the company for Take-Two. That's the PE saying. I should have said it more cleanly, but I think you guys get it. And if we look at the last 5 to 6 years, 33 is pretty low. The lowest has been before $33 is $39. It's been as high as $2,400 the PE has been. I don't know what happened there. We would have to look into that, but the PE's been considerably higher in the past. The 5-year is showing at a 203, and that's very high. That's going to be skewed because of that $2,400 number, and I really don't know where that came from, but I'll look into that, and if I do an updated video, I'll let you guys know. But it looks like right now, at least on a 5-year basis, at a 33 PE, we can start a position right now and feel like we're paying a relatively cheap price for the company right now. You could start a position at this 170 level and feel like you're paying a relatively cheap price when you compare it to the last 5 years. So that's one of the main things you want to use to value a company. The PE ratio is tried and true. Guys like Peter Lynch, I learned a lot about it from Peter Lynch. He actually loved the PEG ratio as well, which is the price to earnings to growth ratio. But you can't go wrong with the old-fashioned PE ratio. Nobody's going to fault you for using that as a valuation metric because it's just so old school and trusted in the business. So, what's the catalyst for Take-Two? So we know that the company is fundamentally sound. I think we can buy it relatively cheaply here. What's the catalyst? There are rumors that Grand Theft Auto 6, their dust starting to kick up. There are some rumors that there may be a new iteration. I'm not going to buy it because the company hasn't come out and said yet that anything's in development. So it's just pure speculation at this point. I think the catalyst is, as I said before, these video game creators are going to become more profitable because digital downloads are exploding for the companies. You also have things like microtransactions, in-game transactions. Grand Theft Auto came out in 2013, and it's still a profitable franchise for the company because they've been able to extend the life of the video game by doing things like adding in new stories, adding in microtransactions. So they're creating, games that have long lifespans and have these their worlds, if you will. And I think going forward, that's going to be a big driver for these companies. Not having to create physical discs is going to trickle up to the top line and down to the bottom line. So I'm very bullish on that as well. But let's take a look at this sheet that I pulled from Take-Two's investor relations page. So far, they've sold 130 million copies of Grand Theft Auto 5. That makes it I believe it's the second best-selling video game of all time. I think that the Call of Duty series just kind of outsells it. But that tells you the power of the Grand Theft Auto series. They've sold 130 million copies so far. Now, if you look to your bottom left, this is what we're talking about, digital deliveries. So digital delivered net bookings grew by 35% last year. That was in 2020. Scroll down to the bottom, it says to a new record, it accounted for 82% of total net bookings. So 82% of their total net bookings were in digital delivered products. This is going to be the way going forward, guys. I'm bullish on pretty much all of the video game publishers, the big three. I love Activision, I love EA, I love Take-Two the most, but I'm bullish on all three because of this reason. I think going forward, not having to create as many physical discs and maybe eventually having physical discs almost be totally done with is it's a possibility. I walk through Target, you walk through Walmart, they still sell physical discs, but looking in each shopping cart, you'd be hard pressed to see one. I can't recall the last time I bought a Blu-ray disc or a video game disc. It's been quite a while, but that's the nature of things. But that's my thesis on Take-Two. I think it's a great company, fundamentally sound. The valuation looks good. What I would recommend is I would probably go into a holding pattern here with the company. I may not take a position yet. I want to see how far this goes. So the company's fallen from 190 to about 170 now. There are price targets in the 210, 220 range from companies like Jefferies, and I really want to see how far this goes. If the company slides down to $150 and the PE gets to the 25 and below level, I'm definitely going to be a buyer at this point. But my recommendation for Take-Two would be to maybe hold it. If you already have a position, I think that you'll be fine. Maybe you want to average down at some point, but I think that this stock is definitely going to go back up at some point. And if there's a surprise Grand Theft Auto 6 announcement, look out. So that's all I got for you on this company, guys. I'm Ty. This is Stock Muscle. Drop me a comment. Drop a like if you like the content. Hit the subscribe button if you want to see more. I'll talk to you guys later. This is Stock Muscle. I'm out of here. Thanks, guys.